In 2026, a quiet yet momentous shift is happening within the U.S. financial system. The new chairman of the Federal Reserve, Kevin Warsh, is set to make moves that will redefine how America handles its massive $39 trillion debt crisis. And it's not going to be without consequences. But for those who are prepared, these changes offer a unique opportunity to grow your wealth even faster. The Federal Reserve has always been a key player in managing America's money supply. But now, with a looming $39 trillion national debt, they are faced with a monumental task. Interest payments on this debt have become the largest part of the U.S. government's budget, and it's not sustainable. So how is Kevin Warsh planning to address the crisis? The new Federal Reserve chairman has a three-part strategy. First, Warsh aims to cut interest rates, a move that could make the debt much more manageable. Lower interest rates will decrease the cost of servicing the debt, but there's a risk. This could trigger inflation. Secondly, Warsh wants to shrink the Federal Reserve's balance sheet by selling off the treasuries they've accumulated over the years. The Federal Reserve will be pulling money out of the economy. This, in turn, will help reduce inflationary pressure. Lastly, Warsh's plan involves leveraging artificial intelligence, AI, to keep costs down, boosting efficiency and productivity across the economy without causing inflation to rise uncontrollably. AI could help businesses operate at lower costs, which would ease inflationary pressures and allow the Federal Reserve to cut rates even further without causing economic damage. This three-part strategy is not without risk, but it could set the stage for tremendous opportunities, especially for those who are prepared. The financial repression of the 1940s serves as a reminder that the government doesn't always pay off its debt. Instead, it inflates it away. If Warsh's plan succeeds, we could see a similar outcome, with the U.S. government benefiting at the expense of savers and bondholders. The key takeaway is that the current economic crisis creates the perfect environment for those who own assets to see their wealth grow, while those who simply save in cash risk losing purchasing power, as we have seen in the past. Stocks, real estate, gold, and other assets will likely benefit from the financial strategies implemented by the government. In the next few years, we'll likely witness a historic shift in how debt is managed, with new laws and regulations being put into place. This is a crucial time for anyone invested in the markets to understand how these changes will impact the economy. Stay informed, stay prepared, and most importantly, invest in assets that will stand the test of time. Now, let's break down how to position yourself for success in this new economic environment, starting with the basics, investing in assets that will hold and grow value even when inflation threatens purchasing power. Learn how you can capitalize on these shifts to build your wealth before it's too late.